Ever pondered over how passive investing works? Well, let's unravel this financial strategy together. Passive investing, as the name suggests, is a more laid-back approach to investment. It's not about racing to beat the market or finding the next big thing. Instead, it's about buying and holding a diversified mix of assets that mirror the performance of a specific index. This could be the S&P 500, the FTSE 100, or any other index that represents a broad section of the market. The philosophy behind passive investing is grounded in the belief that markets are generally efficient. Trying to consistently outperform the market is a tall order, even for seasoned financial experts. With passive investing, the goal isn't to finish first. It's about pacing yourself, keeping in step with the market, and growing your wealth gradually over time. It's the tortoise's approach to the financial race. In essence, passive investing is like a slow and steady race, where you're not trying to cross the finish line first, but just keep pace with the market. Now, you might ask, how does this compare to active investing? Well, let's dive in. Active investing is like being in the driver's seat of a high-performance sports car. You're in control, making frequent decisions, buying and selling assets with the aim of outperforming the market. It's exhilarating, sure, but it requires time, expertise, and often incurs higher fees. Passive investing, on the other hand, is more like taking a scenic train ride. You're following a set track, mirroring the market's performance. The ride may not always be as thrilling, but it's typically less costly and less risky. In the active investing world, you're seeking to beat the market, which can lead to higher potential returns, but also higher risk. With passive investing, you're not trying to outsmart the market. Instead, you're riding along with it, aiming for steady long-term growth. So while active investing can potentially yield higher returns, it comes with higher risk and cost. Passive investing, on the other hand, is a lower-cost, lower-risk approach that aims to mirror market returns. Now, let's delve into a popular tool used in passive investing, exchange-traded funds or ETFs. But what exactly are these? Well, ETFs are investment funds that trade on stock exchanges, much like individual stocks. They represent a basket of assets, such as stocks, bonds, commodities, or even a mix of these. Quite handy, isn't it? Here's the beauty of ETFs. They allow investors to buy a diversified portfolio of assets in a single transaction. Picture this. Instead of picking and buying individual stocks one by one, you could purchase an ETF that holds a wide array of stocks. So you're essentially buying into a ready-made, diversified portfolio. This is why ETFs are ideal for passive investing. They offer diversification and simplicity rolled into one. Now, how do ETFs work? Simply put, you buy and sell ETFs just like you would any other stock. They're traded throughout the day at prices that change based on supply and demand. But what makes ETFs particularly attractive? Well, apart from the diversification we've already mentioned, they also provide liquidity, meaning you can buy or sell your ETF shares anytime during trading hours. Plus, ETFs typically come with lower costs compared to other investment products because they aim to replicate an index rather than actively manage assets. Hence, ETFs can be a simple and cost-effective way to implement a passive investment strategy. Now that we understand ETFs, which ones should you consider? As we delve into the world of exchange-traded funds, a few notable names rise to the top, often tracking key indexes like the S&P 500 and NASDAQ. First up is the SPDR S&P 500 ETF, often referred to by its ticker symbol SPY. As the name suggests, it tracks the S&P 500 index, providing exposure to some of the largest US companies. Historically, it has mirrored the performance of the S&P 500 quite closely, making it a popular choice for those seeking to passively invest in the broader market. Next, we have the Invesco QQQ ETF, or simply QQQ. This ETF tracks the NASDAQ 100 index, which is heavily weighted towards technology companies. If you're looking to gain exposure to the tech sector, QQQ might be your go-to. Then there's the Vanguard Total Stock Market ETF, ticker symbol VTI. This ETF covers the entire US equity market, including small, mid, and large cap growth and value stocks. If you're seeking broad market exposure, VTI could be an excellent choice. However, it's essential to remember that past performance is not a guarantee of future results. While these ETFs have seen solid returns in the past, the market is always changing and there are no sure bets. Remember, the key to successful passive investing is diversification and patience. Happy investing!